First, what are dividends and how do they work? Imagine that you have an orchard, and in that orchard, instead of fruit, you plant company shares. Every tree you plant will grow and begin to bear fruit. These fruits, in this case, are dividends. In other words, the company will give you a part of its profits because you own a tree share. Let's take a simple example. You buy shares in a company that has a very large orchard. When the company sells its products and makes a profit, it decides to share this money with the tree owners, shares. Those owners, it could be you and other investors. In other words, the money she earns does not go into her pocket alone. Some of it ends up in your pocket without you having to do anything. It's as if suddenly the trees started to bear fruit, and these fruits were delivered directly to you without you having to harvest them. Now, instead of selling your tree share to make money, you can simply keep it and let the company continue to give you fruits, that is, dividends. That's the secret. You can live off the fruits of your tree while it continues to grow. The cool part of all this? You don't need to sell your tree. You remain the owner, and it will bear fruit, dividends, as it grows. All you have to do is wait patiently and watch these fruits arrive from time to time, like a nice surprise. Second, how to calculate dividend yield. Imagine that you have several trees in your orchard, and each tree gives you a different amount of fruit, money. To know how much each tree is giving you, you need to calculate the performance of each of them. It's as if you wanted to find out how many fruits each tree gives you, comparing the number of fruits with the size of the tree. To do this, we use a simple formula. Let's see how it works. How many fruits did the tree bear in the year? These are the annual dividends. How big is the tree? Share price. That's the share price. Now, to know how much the tree is giving you in relation to its size, we do a simple division, annual dividends, share price, due to tree yield, dividends. For example, imagine that you have a tree that gives you $10 of fruit per year, dividends, and the size of the tree, the share price, is $100. To calculate the yield, simply do 10 dividends, $100, share price. 0.10 or 10% yield. In other words, you won 10% of fruit in relation to the price of the tree. It seems simple, right? This calculation is important because it helps to understand how much each tree will bear you in fruit compared to its size, how much the share costs. The more income you have, the more fruit money you will earn, and best of all, without having to cut down the tree. Third, covered call ETF strategy. One of the fastest ways to live off dividends is to invest in covered call ETFs. But what does this mean? Let's break this down into parts to make it easier. ETFs. These are investment funds that bring together several company shares in a single product. This way, you don't need to buy each share individually. With an ETF, you have a basket of stocks. Covered call. This part is a little more technical. A call is a call option, that is, the right to buy a share at a fixed price within a certain period. Node covered call. The ETF sells these call options on the shares it owns. By selling these options, the ETF receives a award, a payment, which is distributed among investors like you in the form of dividends. In other words, the ETF makes money not only from the dividends on the shares it owns, but also from the premium it receives from selling call options. Advantage: these ETFs tend to have higher yields in the range of 11% to 12% because they make money from two sources, stock dividends and call option premiums. This means that with an investment of around $280,000, $310,000, you can achieve the goal of $2,900 per month, or $35,000 per year, in dividends. This is much less than you would need to invest in traditional dividend stocks, where you would need around $2 million to achieve the same value. In summary, investing in covered call ETFs is an efficient strategy to generate greater passive income with a smaller initial investment compared to other traditional options. Fourth, high-yield REIT strategy. If you are looking for a way to earn dividends more quickly and consistently, invest in REITs, real estate investment funds, could be the key. These funds invest in properties such as shopping malls, offices, and apartments, and best of all, they share the profit like you. Why consider rates? High yield. Some rates offer very high dividends, which can reach 19% per year. This is much more than you would normally find in traditional stocks. Monthly payments. Imagine receiving money every month like an extra salary without having to sell anything. With REITs, this is possible, as many pay dividends monthly, unlike shares that pay every 3 months. Easy diversification. Investing in real estate can be expensive and complicated. With REITs, you have access to a diverse portfolio of properties without having to deal with rent or maintenance, all with a simple investment in a fund. Examples of REITs with good dividends. Two Harbors Investment Corporation, with 20.3% yield. Brandywine. Realty Trust, with 19.9% yield. Orchid Island Capital, with 19.4% yield. These funds can be an excellent way to generate a constant passive income with very attractive yields. How much do you need to invest to reach the goal? If you choose a REIT with an average yield of 10.8% per year, you will need to invest around $320,000 to achieve $35,000 per year, i.e. $2,900 per month. The best part is that you can start with less money, and with patience and consistency, build that value over time. Beware of risks. Of course, like any investment, REITs have their risks. If the economy struggles, or the real estate market faces problems, dividends could fall. Therefore, it is important to monitor the market and have a long-term strategy. Fifth, Dividend Aristocrat strategy. Now, if you want something more solid and reliable, an excellent option is the Dividend Aristocrats. These are big names market, companies that are part of the index S&P 500, and they have an incredible feature. They increase their dividends every year. There is at least 25 years in a row. Why are Dividend Aristocrats a good option? Stability history. These are well-established companies that have a long-standing commitment to paying dividends to their investors, and preferably increase them annually. This demonstrates consistency and confidence in the company's growth. Security. In difficult times, these companies tend to be more resilient during economic downturns, which means they are good for those looking for stability and security. During difficult times, they can still generate profits and pay dividends. Reliable investment, as these companies have already proven that they know how to pay dividends consistently, they become attractive options for those who want to build a source of passive income in the long term. Dividend Aristocrats examples. Some of the large companies in this group include M, a name known for its diversity of products from adhesive tapes to medical equipment. Leggett & Platt, specialized in furniture products and industrial components. Walgreens Boots Alliance, a giant in the pharmaceutical and retail sector. These companies have an average yield of 7% per year, which may seem smaller compared to rates or covered call ETFs, but the big advantage is the reliability and consistency. How much do you need to invest to reach your goal? If you want to win $2,900 per month or $35,000 per year with the Dividend Aristocrats and considering an average yield of 7% per year, the amount required for investment would be about $500,000. Yes, the initial value may be higher compared to other strategies, but the advantage is in the security and no constant growth dividends over the years, risks and considerations. Although dividend aristocrats are known for their stability, the share price of these companies can fluctuate, which is why it is always important to have a view of long-term. Profitability may be lower in the short term, but the consistency and security make these actions an excellent option for those who want a source of passive income without unpleasant surprises. Sixth, how to build a dividend portfolio. Now that you know some strategies for making money with dividends, it's time to put together an investment portfolio aligned with your goals and lifestyle. Where to start? Set your goal. First of all, know how much you want to earn. If your goal is to live off dividends, determine your monthly or annual goal, such as $2,900 per month. This will guide your investment choices. Diversify your investments. Diversification is essential to reduce risks. Instead of concentrating everything in one asset, invest in a combination of stocks, ETFs, REITs, and dividend aristocrats. This helps protect your portfolio against declines in specific sectors. Choose assets with compatible returns. Look for assets that pay regular dividends and meet your target. REITs and covered call ETFs offer higher yields, while dividend aristocrats are more stable but with lower yields. Adjust according to your risk profile. Assess the risks. Each type of investment comes with its own risks. REITs can be affected by changes in the housing market. Covered call ETFs have risk of losses from expiring options, and dividend aristocrats are safer but with lower yields. Knowing the risks is crucial to making informed decisions. Consider costs and taxes. Brokerage fees and dividend taxes can impact your earnings. Choose investment platforms with low costs and understand taxation in your country. How to maintain the portfolio. After building your portfolio, monitor your investments regularly. It is not necessary to look every day, but do periodic reviews. The market changes, and you may need to adjust your strategy over time to maintain balance and stay on track with your goals. Patience is the key. Investing to live off dividends is a long-term process. Dividends accumulate over time, and with patience and discipline, you can achieve financial independence. Start early, reinvest dividends whenever possible, and over time you will see results. Seventh, the importance of reinvesting. Dividends. When you start investing and receiving dividends, you have an important choice. Keep the money or reinvest dividends. Let's understand why reinvest dividends. It can be one of the most powerful strategies for building your financial independence. Why reinvest dividends? Reinvesting your dividends means using the money received back to buy more shares or funds instead of spending. This creates an effective snowball where your money starts to grow exponentially over time. The power of compound interest. The secret behind reinvestment lies in the concept of compound interest. Imagine that you invest in a stock that pays dividends of 5% per year. If you reinvest these dividends, you will not only earn dividends on your initial investment, but also on the dividends you have already received. This effect helps your money grow faster. As with each dividend payment cycle, the value of your investment increases. The more you let your dividends accumulate and reinvest, the faster your portfolio will grow. Practical example. Let's assume you have invested in stocks that pay $2,000 per year in dividends. If you take that $2,000 and reinvest, next year you will receive dividends on the $2,000 you received and the additional value you purchased with that money. Over time, this snowball effect can turn into big gains. Therefore, if your objective is to achieve $35,000 per year in dividends, starting to reinvest early can help you get there much faster. When not to reinvest? Although reinvestment is an excellent strategy for those looking for long-term growth, there are some situations in which it may not be the best option. Need for immediate income. If your objective is to generate a passive income to live off dividends, now you might want to do not reinvest, rather use the money to cover your expenses. Change of strategy. Sometimes you may decide to change your investment strategy. In that case, it might be better withdraw dividends and use them in new investments that align more with your current goals. Eighth, how to reach your passive dividend income. Goal set. Your passive income goal. The first step is to determine how much you want to earn per month or per year. The value will vary from person to person depending on lifestyle and goals. For example, if your goal is to earn $2,900 per month or $35,000 per year, you will need to calculate how much to invest in dividend-paying assets. Choose the right investments. With the goal defined, it's time to choose where to invest. Some options include high-yield REITs. They can generate higher dividends, but with greater risk. Dividend aristocrats. Companies with a history of paying stable and consistent dividends, but with a lower yield. Covered call ETFs. They offer interesting returns through dividends and options, making them a good strategy for a constant cash flow. Diversify to reduce risk and increase your chances of success. Determine the amount to be invested. Now, calculate the amount needed to reach your passive income goal, considering the average return on the chosen investments. Examples: REITs, 10.8% per year. Invest around $320,000 to generate $35,000 per year. Dividend aristocrats, 7% per year. Invest around $500,000. Covered call ETFs, 11% per year. Invest around $280,000. Automate your investments and be consistent. Investing regularly is essential. Use platforms that allow investment automation, which creates discipline and ensures consistency. Reinvest dividends to accelerate your portfolio growth through compound interest. Stay focused and have patience. Achieving financial independence with dividends is a long-term process. Don't give up on market fluctuations. The important thing is to follow the plan with patience and consistency. Ninth, how to deal with risks in dividend. Investing in dividends can be a good way to achieve financial independence, but it involves risks. These risks come primarily from stock markets, changes in stock prices, and other economic conditions. Understanding the risks and knowing how to manage them is essential to protecting your money. Main risks: drop in share price, shares of dividend paying. Companies may lose value due to economic crises or inadequate management, which impacts the portfolio's profitability. Dividend reduction or cut. Companies may reduce or eliminate dividends in case of financial difficulties or to reinvest in the company's growth. Inflation. Inflation can reduce the purchasing power of dividends, decreasing their real value over time. Interest rate. High interest rates can make alternatives like government bonds more attractive, reducing the value of shares in companies that pay dividends. How to manage risks. Diversification. Spread your investments across different types of assets, stocks, ETFs, REITs, to reduce the risk of large losses. Choose reliable companies. Invest in companies with a proven track record of consistent dividends, such as those in the S&P 500 index or Dividend. Aristocrats' regular portfolio review. Keep your portfolio aligned with your long-term goals by making adjustments as needed. Prepare for crises. In times of market decline, be patient and consider using volatility to your advantage to buy more shares. 10th, the importance of having an investment plan to achieve financial independence with dividends. It is essential to have a well-structured investment plan. Without it, you can make impulsive decisions and have results below expectations. A good plan helps organize investments and stay focused on the goal of generating passive income. Why is an investment plan essential? A plan is like a map. Without it, you can get lost, making bad decisions due to emotions like fear or greed. With a good plan, you define where, how much, and how to invest based on clear objectives and reliable information. How to create an effective investment plan. Set your long-term goals. Determine how much you need to live comfortably on dividends, e.g. 2,900 month or 35,000 hours year. Determine how much to invest. Calculate the amount needed to reach your goal, considering the annual return on investments, 7% to 11%. Choose the right investments. Choose assets such as REITs, dividend aristocrats or ETFs, and diversify to minimize risks. Establish a regular contribution strategy. Invest constantly, setting up automatic monthly contributions to maintain the rhythm. Evaluate and adjust your plan periodically. Review the plan every 6 months or year and make adjustments as needed. Maintain discipline and patience. Passive income is a long-term game, so avoid impulsive decisions. Benefits of having an investment plan. Emotional control. Resists impulsive decisions, even in volatile markets. Better use of money. Maximizes the returns on your investments. Less risk of failure. Well-founded decisions reduce the chances of error. And there it is. Now that you know the 10 fundamental strategies to invest and live off dividends, you are ready to take the first step towards your financial freedom. Remember, the key to achieving financial independence is consistency, the planning and others' discipline. By setting your goals, choosing the right investments, diversifying your portfolio, and staying focused, you will be building a more secure and peaceful future based on passive income from dividends. Don't forget that, although the path to living off dividends is a gradual process, with patience and commitment, the results will come. The sooner you start, the faster your portfolio will grow and the closer you will be to achieving the dream you dream of. Financial freedom. If you like this content, be sure to like the video and subscribe to the channel so you don't miss any more tips on how to invest smartly and achieve your financial independence. Let's go on this journey together until the next video.